If you fancy taking a plunge into shares, which one should you choose? Let's ask George Godber, funding partner, fund manager at Matterley, which has £140 million under management. Hi, George.
Morning.
Thanks for joining us today. I've been looking at the fund that you principally manage, the Matterley Undervalued Returns Fund. It's been a tough couple of months, hasn't it?
Yeah, it's been a very tough quarter for UK equities, but over the longer term, we've had good, strong performance over the last 3 years, which does give us some leeway, over the next sort of coming months.
When you've had a decline of 5% in September, 9% in August, how does that affect your thinking? How does that affect your strategy, your long-term vision?
I think the key question to ask ourselves is, we aren't taking any balance sheet risk really in the investments we're making. About 80% of the portfolio we hold today are net cash companies. They've got a lot of financial strength. Am I happy to own the franchises for the next 10 years? Absolutely. Clearly, we're in an incredibly difficult macro position. The performance we've reflected is reflective of the markets that we're in. That's what the UK equity market has fallen. But have I been able to upgrade the portfolio and buy some fabulous franchises at enormous discounts to history? Then yes, very much.
Caroline was just asking the question with regards to US stocks. Are US stocks cheap? And she was basically saying, look back at the last 9 recessions. Yes, they're very cheap. Can the same be said for the UK stock market?
Yeah, definitely. There's a couple of, simple earnings measures would suggest yes. Is it good to back those? Well, yes. If you look at, what happened if you put money in 74 in the oil crisis, the 80s recession, the 90s recessions were at similar earnings multiples, then yes, absolutely. We've obviously had that key crossover of equity yield versus government bond yield, which has proved to be a very good, indicator in the past. It's an even stronger indicator in the US, where it has recently happened as well.
What's your key valuation tool? Everyone has their own preference. For you, what's the metric of choice when you're looking at valuation?
We're very, very price-to-book orientated, very value-orientated. So the sort of companies I'm looking at today are, can I buy a stock like Sainsbury's for cheaper than it would cost me to replicate the business today on the screen? Sainsbury's market cap £5.5 billion, debt of £2 billion, paying £7.5 billion for that business. It's got probably backing of £7.5 billion that was last struck in the mid-90s. So you couldn't replicate that business. I'm getting paid a 6% dividend yield while I wait for this, what I think is a good franchise, to sort of be re-rated for the market in the next 18 months.
I've been looking at the fund. I mean, you hold all the biggies, don't you? The Vodafones, the Astras, the Rio Tintos. Just give us some picks, George, some potential smaller companies, potential winners that have been knocked down heavily in the last few months, where there could be some money to be made.
Well, I actually think a stock like Vodafone is absurdly cheap. Better credit rating than the government and yielding you 8% today. At some point, the hunt for income will drive those shares up. But lower down the market cap scale, the sort of stocks I'm finding really interesting, Petrofac, which probably the UK's most successful business, may not be that well known on the street, but adjust for the cash in the balance sheet, you're paying sub 10 times for that franchise. I look at some of the small cap stocks like Tulloch that we've been buying, a huge beneficiary of market volatility, and unfortunately we've certainly got that, and I feel it's it's here to stay. Right even down to some of the micro caps that we hold, stocks like Sagentia, which is a consulting business that helps stock companies like Johnson & Johnson with their outsourced R&D. That's a business trading on 3 or 4 times earnings with net cash in the bank, significant property backing. It may be a micro cap, but I think it's a fabulous investment for the longer term.
Mining's the biggie, isn't it? I mean, it's 14.5% of the portfolio. We know how mining stocks did in September, down 19% as an industry, worst month, should I say, since October 2008. Are these stocks looking knocked down too much, or...?
I think it depends on which commodities and where you're exposed. There's obviously significant downgrade risk. Look at Bloomberg, you can see where analysts are behind the curve, if you like. But again, are the stocks below build? Rio Tinto today, you couldn't replicate for the money they've sunk into the ground. That business is worth more to other people around the world than it is the stock market. And we've had people prowl around it before, and at these prices, I wouldn't dismiss that happening again. Likewise, similar situation with the Anglos of this world. They're trading below what they've sunk into the ground. Now, clearly, there are some other stocks which are probably too leveraged, have got the wrong balance sheets. But Rio Tinto gets net cash this year, so I think there's some really interesting value in mining. But until you get clarity on Greece, Europe, US, then you won't get the significant movement.
George, thanks for joining us today.
Thank you very much.
We'll see you soon.